Right now, while you're watching this video, millions of investors are making the single biggest mistake of their entire year. Not in a boardroom, not during a market crash, not when they panic sell. They're making it at a Christmas dinner table. And the cost? Decades of compounding returns erased, tax efficiency destroyed, retirement timelines delayed by years. Most people think the hardest part of investing is picking stocks or timing the market. They're wrong. The hardest part is doing absolutely nothing when everyone around you is screaming that you should do something. By the end of this video, you'll understand why the most dangerous financial advice you'll ever receive comes wrapped in tinsel and good intentions. Christmas isn't just a holiday. For your brain, it's a financial pressure cooker. You sit down with family, someone asks how your investments are doing, your cousin brags about a stock that doubled, your uncle complains about his losses, your friend says they're pulling everything out because the market feels unstable, and suddenly, without realizing it, you're questioning everything. This isn't accidental. Human psychology has a fatal flaw when it comes to money. We treat financial decisions like social decisions. When your family asks about your portfolio, your brain doesn't activate the analytical circuits used for math or logic. It activates the circuits used for status, belonging, and threat detection. You stop thinking like an investor. You start thinking like a tribe member trying to not get exiled. This is why the person who stays calm through a 20% market correction will panic and sell everything after a single conversation with their brother-in-law. The trigger isn't the market, it's the dinner table. Let me show you how this plays out in real time. Imagine you've been investing consistently all year. You've stuck to your strategy, you haven't checked your portfolio obsessively, you've ignored the noise. Then December hits. You're at a party, someone mentions they sold all their tech stocks last month and avoided the dip. They feel smart, they look smart. Everyone nods in agreement. Your brain registers this as proof that you should have done something, proof that staying the course was naive. So you go home and open your brokerage account, you start second-guessing. Maybe I should rebalance, maybe I should take some profits, maybe I should wait for a better entry point. Here's what just happened. You went from investor to gambler in 30 seconds. Because the moment you start making decisions based on what other people did last month, you've abandoned strategy and embraced randomness. And randomness in investing is just a polite word for losing. There's a specific psychological mechanism at work here, and it's one of the most destructive forces in personal finance. It's called reference point bias. Your brain doesn't evaluate your portfolio in absolute terms. It evaluates it relative to other people's portfolios. If your friend made 40% this year and you made 15%, your brain interprets your 15% as a loss, even though it's a fantastic return. Even though your friend probably took insane risks to get that 40%, even though their strategy is unsustainable. Your brain doesn't care. It just knows someone else won more. This is why investors consistently underperform the market. Not because they pick bad stocks, but because they can't stop comparing themselves to the outliers. You know what's worse? The people bragging at Christmas are almost always the outliers who got lucky. The people who lost money, they stay quiet. So your sample set is completely poisoned. You're comparing yourself to a curated highlight reel of anomalies, and then you make decisions based on that. This is financial suicide disguised as social interaction. Here's where it gets even more dangerous. When family and friends give you investment advice, they're not trying to help you, they're trying to validate themselves. Think about it. Why does your uncle tell you to sell everything and go to cash? Because he already did it. And if you don't do it, his decision looks irrational. He needs you to agree with him, not because he cares about your portfolio, but because he needs external confirmation that he didn't just make a catastrophic mistake. This is why bad financial advice spreads like a virus during the holidays. It's not about information, it's about emotional contagion. And the worst part, the advice always sounds reasonable. I'm just being cautious. I'm taking profits while I can. I'm waiting for things to stabilize. These phrases sound smart, they feel responsible, but they're just fear dressed up as wisdom. Because here's the truth, every single person who tells you to pull out of the market is admitting they don't trust their own strategy. And if they don't trust their strategy, why on earth would you trust their advice? There's another trap waiting for you at Christmas, and it's subtle.
It's the belief that you can time the market if you just pay close enough attention. Someone tells you they moved everything to bonds before the last correction. They sound confident. They have a reason. It all makes sense. So you start thinking, maybe I should be more active. Maybe I'm too passive. Maybe I'm leaving money on the table. Here's what you're not seeing: survivorship bias. For every person who successfully timed the market, there are 100 who tried and failed, but you only hear from the one who got lucky. And even that person, they'll probably fail next time, because market timing isn't a skill, it's a coin flip with a narrative attached. The data is crystal clear on this. The average investor who tries to time the market underperforms the market by 3 to 4% annually. Not because they're bad at analyzing, but because human psychology makes it impossible to buy low and sell high consistently. You know when most people buy? After prices have already gone up, because that's when it feels safe. You know when most people sell? After prices have already crashed, because that's when the pain becomes unbearable. This is the exact opposite of what works, and it's why the people who talk the most about market timing usually have the worst returns. Let's talk about something most people think is smart during Christmas: year-end rebalancing. On paper, it makes sense. Review your portfolio, adjust allocations, lock in gains, reduce risk. But here's the problem. Most people use rebalancing as an excuse to tinker. They see that tech stocks outperformed this year, so they trim tech and buy more bonds. Not because their risk tolerance changed, not because their timeline changed, but because it feels like the responsible thing to do. This is a mistake. Rebalancing should be mechanical. It should happen on a schedule based on predetermined rules with zero emotion involved. But that's not what happens at Christmas. What happens is you talk to people, you feel uncertain, and you use rebalancing as a way to scratch the itch to do something. And every time you do that, you're making a bet that your gut feeling is smarter than the market. Spoiler, it's not. The investors who win aren't the ones who rebalance constantly. They're the ones who rebalance rarely, according to a plan they set years ago and never deviate from. Now, let's talk about something almost no one thinks about during Christmas: taxes. When you sell investments, you trigger capital gains. If you've held those investments for less than a year, you're paying short-term capital gains tax, which is the same rate as your income tax. So if you're in the 24% tax bracket and you sell $10,000 in gains, you just gave $2,400 to the government. For what? Because someone at a party made you nervous? Here's what makes this even worse. If you sell in December and then rebuy in January because you want to get back in, you've just donated thousands of dollars to the IRS for no reason. This happens constantly. People panic, sell, trigger taxes, then realize they overreacted and buy back in at a higher price. It's a triple loss. You locked in taxes, you missed the recovery, and you bought back in at a worse entry point. And it all started because you couldn't sit still during Christmas.
There's a specific type of conversation that happens at the end of every year, and it's poison. Did you hear about crypto? Did you see what happened with AI stocks? Did you get in on that IPO? These questions are designed to make you feel like you missed out, like everyone else is making money and you're sitting on the sidelines. This triggers FOMO, fear of missing out. And FOMO is the most expensive emotion in investing, because FOMO makes you chase, it makes you buy high, it makes you abandon your strategy and jump into whatever is hot right now. And by the time you get in, the smart money is already getting out. This is how bubbles form, not because assets are fundamentally overvalued, but because millions of people simultaneously decide they can't afford to miss out. And when the bubble pops, those same people lose everything, because they didn't buy an asset, they bought a narrative, and narratives collapse faster than prices. Here's the paradox that destroys most investors. The times when you feel most compelled to do something are exactly the times when you should do nothing. When your portfolio is down 20% and everyone is panicking, your instinct is to sell, but that's the worst possible time to sell. When your portfolio is up 50% and everyone is euphoric, your instinct is to buy more, but that's the worst possible time to buy. The optimal strategy, stay the course, ignore the noise, stick to your plan, feels wrong at every stage. During crashes, it feels reckless. During booms, it feels lazy. This is why discipline is so rare. Not because it's complicated, but because it requires you to constantly act against your instincts. And Christmas amplifies this because you're not just fighting your own instincts, you're fighting everyone else's instincts projected onto you. Your family isn't just telling you what they did, they're telling you what they think you should do. And their certainty makes your discipline feel like stubbornness. But it's not. It's the only thing standing between you and financial mediocrity. Let's zoom out for a second. If you started investing in the year 2000, right before the dot-com crash, and you never sold, never panicked, never tried to time the market, do you know what your average annual return would be? Around 7 to 8%, even with two of the worst crashes in modern history. Now, let's say you panicked during the dot-com crash and sold, or you panicked in 2008 and sold, or you sold during COVID. Your returns would be cut in half or worse. The difference between wealth and mediocrity isn't picking better stocks. It's not having insider knowledge. It's not being smarter. It's sitting still when everyone else is moving. That's it. That's the entire game. But sitting still is the hardest thing in the world because it feels like you're not doing anything. And in a world that worships action, inaction feels like failure. But in investing, inaction is the strategy, not the fallback, not the lazy option, the strategy. Let me give you a mental model that will change how you think about investing. Stop thinking about your portfolio as a scoreboard. Start thinking about it as a garden. A garden doesn't grow because you check on it every day. It grows because you plant the right seeds, water them consistently, and leave them alone. If you dig up the seeds every week, they die. Your portfolio is the same. Every time you check it, every time you tinker, every time you make a small adjustment, you're digging up the seeds. You're disrupting the process that creates growth. Compounding doesn't happen in days or weeks. It happens over years and decades. But it only works if you let it work. And the people who let it work are the ones who stop checking, stop comparing, stop listening to advice. They plant, they water, they walk away. And 20 years later, they're wealthy. So here's the decision you actually need to make this Christmas. It's not whether to buy or sell. It's not whether to rebalance. It's not whether your cousin's stock pick is better than yours. The decision is this. Are you going to let other people's anxiety dictate your financial future? Because that's what's really happening. Every time you listen to someone else's opinion, you're handing them control over your money. They don't have to live with the consequences. You do. If your uncle convinces you to sell and the market goes up 30% next year, he won't feel bad. He'll just find a new reason why he was still right. But you'll have lost years of compounding, and you can never get those years back. This is the invisible cost of social pressure. It's not just a bad trade, it's a compounding loss that echoes through your entire financial life. Here's a radical idea. Stop talking about your investments. Seriously, stop. Don't tell people what you own, don't tell them how you're doing, don't engage in the conversation. When someone asks, smile and say, "I'm staying boring and consistent." That's it. No details, no justification, no defense. Because the moment you start defending your strategy, you've opened the door to doubt, and doubt is the enemy of discipline. The best investors I know, they don't talk about their portfolios, not because they're secretive, but because they understand that every conversation is an opportunity to second-guess themselves, and second-guessing is the fastest way to destroy long-term returns. Let me show you what doing nothing actually looks like in practice. Let's say you invest $10,000 at the start of the year. The market goes up 10%. You do nothing. You end the year with $11,000. Next year, the market crashes 20%. You do nothing. You end with $8,800. Third year, the market recovers 30%. You do nothing. You end with $11,440. Fourth year, the market is flat. You do nothing. You still have $11,440. Fifth year, the market goes up 15%. You do nothing. You end with $13,156. You started with $10,000. You did nothing. You now have $13,156. Now, let's say your friend tried to be smart. They sold after year 2 because they were scared. They waited for things to stabilize. They missed the recovery in year 3. They're still sitting on $8,800. That's a $4,356 difference, and it compounds every year after that. This is the power of doing nothing, not in theory, in reality. I want to give you explicit permission to do something radical this Christmas. You have permission to ignore every piece of financial advice you receive. You have permission to not care what your cousin's portfolio looks like. You have permission to skip the conversation entirely. You have permission to be boring, because boring wins every single time. The people who get rich slowly and quietly aren't the ones with the best tips or the smartest strategies. They're the ones who ignored everyone else and stuck to the plan. And the plan is simple. Buy good assets, hold them, and don't touch them. That's it. That's the whole thing. Everything else is noise designed to make you feel like you're not doing enough. But you are. You're doing exactly enough. You're letting time and compounding do the work. And that's the only strategy that actually works. So here's the most important financial decision you'll make this year. Will you let Christmas derail your strategy? Because that's the decision. Not what to buy or sell, not whether to rebalance, not whether your cousin's stock pick is better than yours. The decision is whether you'll let 1 month of social pressure override years of discipline. Most people will say yes. They'll make small adjustments, they'll tinker, they'll react, and in 10 years, they'll wonder why they're not wealthy. You don't have to be most people. You can be the person who did nothing, who stayed boring, who ignored the noise. And in 10 years, you'll look back and realize that doing nothing was the smartest thing you ever did. If this video made you rethink how you approach investing, do me a favor, hit the like button, drop a comment telling me what decision you're making this Christmas, and if you want more content that cuts through the noise and focuses on what actually works, subscribe. Because the best investment advice you'll ever get isn't complicated, it's just really, really hard to follow. See you in the next one.